Sometimes in the morning, when I'm looking in the mirror, I say to myself, I could lose 5 or 10 more pounds. I'd probably feel a lot better. I'd probably look a lot better too. And then usually later in the day, in the evening, I reflect on this desired outcome as I'm sitting on the couch eating potato chips.
Are you ready to make the most of the only life you have? To make smart money choices focused on achieving what you care about most? Here to help you balance living well today without sacrificing your tomorrow is the Retirement Answer Man, Roger Whitney.
An important principle of personal accountability is reflecting on whether the actions that you're taking are consistent with the outcomes that you desire. Obviously, in my case, eating potato chips on the couch are not consistent with the desired outcome of losing 5 or 10 more pounds. And it's amazing in how many areas the actions we take are not really consistent with what we say we want to have happen in our lives. It could be those closer relationships with people close to you, your family, your friends, your kids, having the phone out, texting, or playing a game while you're having dinner with the kids or your wife is not consistent with having a closer relationship. Likewise, if you want to retire someday in the future, are the actions you're taking, the controlling the spending, the saving, the investing, are they consistent with that desire to retire? Now, it gets even more interesting when we get really close to retirement, when we've been in this accumulation phase for decades, and we have a style of investing, even if it's asset allocation. Usually when you're about to retire, the desired outcomes are live the way you want or maintain your lifestyle during retirement, and 2, not run out of money. So the question is using traditional asset allocation alone consistent with those desired outcomes? And that's what we're going to explore a little bit today as we work on building a foundation of knowledge to be able to invest to create the life that we want. But we can't do any of that before we have this important disclaimer. That's right. It's time for that all-important disclaimer. Did you realize you cannot invest directly in an index? Can't do it. You got to use some kind of vehicle to do it. Did you also know that past performance is no indication of what future results could be? Did you also know that different types of investments have different levels of risk, and you got to find the ones that are appropriate for you? So what I would suggest that you do is 1, think of this as helpful hints in education. 2, before you make any decisions, consult your legal advisor, your tax advisor, or your financial advisor, because that's just common sense. Now, let's get to hot topic and talk about a really big, nasty problem. So in the news today, Bloomberg View reported that William Sharpe, the Nobel laureate economist at Stanford, who was responsible for some of the foundational models of modern portfolio management, the Sharpe ratio, the capital asset pricing model, some things that are really important when it comes to managing assets. He is trying to tackle what he calls the nastiest, the hardest problem in finance. No, it's not where the market's going next year. He calls this problem decumulation, or the use of savings in retirement. He says this is the big problem that nobody's figured out yet. We've figured out asset accumulation, as the baby boomers have accumulated assets using asset allocation and such. But he says this decumulation problem is not one that's been very well addressed yet. He says the one-size-fits-all approach of a 4% withdrawal rate or some of the more simplistic things out there aren't cutting it because the outcomes are almost infinite. In true Nobel laureate speak, he says it's a multi-period problem with actuarial issues in a multi-dimensional scenario matrix. Spoken like a true Nobel laureate. Basically, it's a big, nasty problem. Some of the reasons why are these multi-facets that we have to deal with are, 1, how long are you going to live? Nobody knows. And longevity is increasing. That is a big determinant on what might work and what might not. The second is, hey, in any one year, There are over 100,000 plus possible market outcomes in any one year. How do you factor all those into your equation when you're trying to figure out this decumulation phase of your life? 3 is inflation itself. Inflation is usually used as the nominal term that you apply to things. We use 4%, which is roughly what CPI has been since 1970. But inflation by itself can vary greatly, not just by period, but by your spending level and spending habits. Another factor in this multidimensional scenario is the income that you receive and the timing of when those incomes come in and whether they're inflation adjusted or not. And then lastly, spending patterns. The spending patterns from year to year throughout retirement have an almost infinite number of scenarios that can play out based on needs, wants, and wishes, based on go-go years, slow-go years, no-go years, based on healthcare events, based on so many things. And according to William Sharp, this decumulation phase hasn't really been figured out. So he has started the Retirement Income Scenario Matrix Project through the Stanford University website, where he is working with graduate level students on financial engineering to build up a body of work to try to figure this all out. Now, I totally agree with Dr. Sharp, I guess I'd call him, in that the old ways don't work. In my mind, maybe because I'm not a Nobel laureate, it's almost impossible to figure out. That's why more than ever, you need to have an agile process, like agile retirement management, to be able to make more consistent, smaller decisions so you can adjust as reality unfolds. So now let's explore asset allocation as a methodology for investing and look at some of the nuances of why it might not be the entirety of what you need to do to successfully invest during retirement. Time to get your geek hat on for the next installment of the Investing for Retirement series. Hey, we've done a lot over the last few weeks. We've talked about historical returns. We introduced the concept of risk in terms of how finance people think of it. We've talked about how modern portfolio theory was developed and how it got solidified as the best practice in terms of asset allocation in the 70s with institutions, and then how financial planners adopted it in the 80s, and it's become the standard practice today of creating a pie chart of different asset classes to build a portfolio. So now we need to explore if that's enough. Is using asset allocation alone consistent with achieving the desired outcomes that you have in retirement in that decumulation phase? If it is, then the science is enough, right? The science is enough. We just need to fill out a risk tolerance questionnaire, feel comfortable it's accurately gauge that, and then let it spit out a pie chart, and then invest and rebalance. If it's not, then we may need to add some more to it. We may need to add some art and skill in addition to asset allocation. Since asset allocation started as an institutional best practice, let's start with looking at what the differences are between you and your family and an institution. So an institution has a very, very, very long time horizon. It could be over 100 years, whether you're a foundation or you're a pension. Their investment time horizon is a very long period of time, which means statistics have a lot longer to be able to average out, to be able to get the breadth of those statistics. Secondly, institutions invest for institutional type of reasons. They invest to pay out pensions. They invest to give grants and do good as far as foundations. And they have a lot of control over what that payout is. It's not affecting them in any personal way if they have to lower it or raise it. They don't have life goals. They just have payout goals, which is very different. They have vast amount of resources. They generally get lots of contributions through employer contributions in a pension's sake or donations in terms of a foundation. So they have a vast amount of resources. And they aren't near as emotional as you and I because it's not their money. They're just stewards of someone else's money. And if it doesn't go right, their personal life doesn't blow up. So those are some of the attributes of an institution when implementing asset allocation. They have a long time, so the averages can work out. They have different kinds of spending goals. They have a lot of resources, and they aren't really as emotional as you and I are. Now, let's look at you and I as we are investing for retirement. Well, our timeline's a lot shorter. Sure, we may live 30, 35 years in retirement, but that's a lot less than 100. And those 30 years are super important years to us because we can't wait for the long-term averages to average out for us when it comes to investing. If we invest in the wrong season, it could be lights out for us in terms of the goals that we have. You and I have to deal with inflation because we're in that decumulation phase. We are worried about the purchasing power that we have, unlike an institution or near as much as an institution. To you and I, it's very personal of having to fight that long-term threat of inflation. You and I, even if we've accumulated mass resources, generally in retirement, that accumulation has stopped. Our earnings power has diminished or gone away entirely. So now we're totally dependent on our assets, which is very different than an institution. Oh yeah, in case you didn't know it, you and I, we're really emotional. If we're sitting there and we're 60 or we're 65, this is all the money we got. We've already left our work. We can't earn any more money. We're pretty emotional. That's an emotionally charged state when we're trying to make decisions. And then lastly, we are decumulating assets. We are spending the assets that we have, and we have to make sure that they last for a lifetime that we don't know exactly how long it is. We are very different than institutions. So the question becomes, does this institutional approach of asset allocation that now is best practice for everybody really fit what we're entering into when we're in retirement? So I can remember in the 90s when we were in the new economy. I was a fairly fresh financial advisor. I started in 1990. I didn't know what I didn't know for sure. And returns were pretty easy to come by. Markets were pretty strong from the mid 80s all the way to 2002. It's pretty good markets. So if you look at the month that I entered the business, I think it was September of 1990. If you look at the month that I entered the business, 1990, September, and go out 10 years to August of 2000, the S&P 500 had an average annual return of 17.66%. That was a beautiful season to be an investor. Now, I didn't know what I didn't know, and it just really taught me a lot of bad habits because I had such great markets as a tailwind. But think about this. So someone that retired in 1990 had, on average, a 17.5% rate of return each year if they invested in the S&P 500. Wow, that's some tailwind that can really set you up for a great retirement. So as a result, there were a lot of people that were able to retire, not really know what they didn't know, and still have everything work out okay. Now let's look at another 10-year period in the S&P 500. Let's say we had someone that invested or decided to retire in September of 2000. So 10 years after that particular return. We had a 10-year period from September 1990 to August of 2000, where the returns were roughly 17.5% in the S&P 500 index. Now let's look at another person who retired in September of 2000, roughly exactly 10 years later. What was the 10-year return from September 2000 to August 2010? It was negative 1.81% per year. Per year. You had the bear market of 2002 and the technology bubble burst, and then you endured 2007, 2008. So you can see how drastically different the seasons of investment returns can be. Even if the long-term average is 10%, you can have wildly different seasons along the way. And the problem is, where you're sitting right now, you don't know what season is going to be the next season. So if you're simply implementing asset allocation, regardless of what the averages are, if you happen to have the poor luck of investing right before a drought in terms of investment returns, you could be in trouble. Because we had an interview with Michael Kitces about a year and a half ago. We'll have to get him back on, talking about how mathematically, if you have really bad returns on the front end of retirement, you're so far behind the eight ball that there's almost no making up. So this lends us to think asset allocation can't be 100% of the whole story, because this is the only life you have. You can't just simply lower your distribution rate like an institution. This is your life when you're stopping working and stopping accumulating. So we can see how volatile the seasons can be in these averages. But you say, Roger, I'm probably not going to invest 100% in stocks. So let's look at a asset allocation. Let's look at 60% in stocks, represented by the S&P 500, and 40% in bonds, represented by the Intermediate Treasury Bond Index. So we're going to go back to 1950. So from 1950 to 2015, that's where these numbers come from. And we're going to look at rolling returns. So what is a rolling return? We're getting our geek on now. So if we're going from 1950 to 2015, that's roughly 6 decades, right? If you just went by calendar year, you don't have 6 different decades to be able to look at. So what a rolling return looks at, okay, January 1950 to December, or January, what's called January 1960, and then February 1950 to February 1960, and so forth. So that's what a rolling return is. And during that same time period, from 1950 to 2015, there were 672 observations, 10-year periods that we can track. So what I want to look at is, during that time frame, the average return of that 60% stock, 40% bond allocation was 8.9% over all of those periods of time. That's great. So that was the average of all those 10-year observations. Now, the highest 10-year average during that period of time was 16.2% a year. Hey, that was a season of some awesome returns. But the worst was basically flat, 20 basis points, which is about 0.1%. So the worst 10-year period during those 672 periods was basically flat returns for 10 years. That could destroy your retirement if that happened on the front end. But the best, if you had the good tailwind, was over 16%. So even with an asset allocation, there are very different seasons of returns that you might experience. And we're sitting here at the beginning of the race when you retire. We don't know what's going to be ahead. So simply using asset allocation and betting on long-term averages is not an action that is consistent with a desired outcome of maintaining your lifestyle and not running out of money. There's too much variability on what could possibly happen during that time frame. Oh yeah, and we're not talking about cash flows of deposits or withdrawals. We're just looking at point to point what the average return was. When you start to factor in cash flows of either contributing money or taking money out, it can change the landscape even more. So let's talk about that. So just this last week, I was talking with a listener who is 28 years old. What a 28-year-old is doing listening to a retirement podcast, I have no idea. Obviously, this person is very intentional. And she emailed me and she wanted to have a general conversation about investing for retirement. Now, she's not someone that can be a client. I only work with people 50 and older that are on this journey. But we were talking about how she should allocate her retirement assets. And although I couldn't give her specific recommendations, I talked about the issues facing her in terms of risk and reward. And we talked about the power of dollar cost averaging. Now, if you remember dollar cost averaging, it's when you're investing a consistent amount in a consistent way over a very long period of time. Let's say it's $1,000 a month that you're investing. What happens over time is as markets go up, you're still investing your $1,000. So you buy less shares because the prices are higher in good markets. But when markets go down, you're still investing your $1,000, but the price is so low that you end up buying a lot more shares when markets are really bad. And when you're young, if you're consistent with it for long enough, it can be really powerful because you can buy boatloads of shares when things are bad and buy less shares when things are high. So in a perverse way, if you're really young, you want markets to go down because that's when you're contributing and buying assets. And statistically, if you run the math, it can work out to do really well. Well, when you're taking money out in the decumulation stage, that magical power of dollar cost averaging works in reverse. And this was that conversation I had with Michael Kitces a while ago. If you are taking money out consistently, you're dollar cost averaging, but just in reverse. So let's say rather than contributing $1,000 a month, you're taking out $1,000 a month. So if you have bad markets, you have to sell more shares to get your $1,000 out. So if you have a bear market in the beginning of retirement and you're taking out your $1,000 a month, the numbers are worse than what we just talked about because you're having to sell more and more shares to get your same $1,000 a month out. So when markets ultimately recover, you've sold so many shares that you're pretty much behind the eight ball. That's what happened with a lot of people that retired and just used asset allocation and for just pure bad luck had bad returns right at the beginning and had to sell so many shares to get the money that they needed that when the markets recovered, they didn't have near enough shares to really rebound. It just magnifies the impact of these seasons of returns when you factor in cash flows. It's good if you had bad markets on the front end, if you're putting money in, but it's pretty bad if you're taking money out. So when we're looking at asset allocation as the be-all, end-all for how you invest for retirement, there are some issues. Well, number one, it's determining your risk tolerance to decide what that pie chart should look like, what mix of assets that you should have. In doing that, it doesn't account for your individual life. It doesn't account for what you want as a desired outcome. It's just simply looking at trying to figure out your maximum risk tolerance and then positioning yourself to probably experience it in trying to optimize returns. What ends up happening in retirement, in reality, is in some instances, you can have less in terms of an average annual return and have better outcomes than something that had greater returns on average if the returns are more consistent. Consistency becomes your friend when you're starting to draw money out, just like volatility is your friend when you're young and investing money. So asset allocation in terms of doing risk tolerance and just implementing a pie chart is suboptimal. It's not enough of the story for you to use as an investment process. Doesn't mean it might not work. It's just suboptimal because it doesn't incorporate you as a person. It's more made for an institution. So what we're going to do next episode is we are going to start to talk about how do we use this foundation of asset allocation, which I think is a sound foundation to use to help to manage risk. But then how do we adjust it to our situation as we enter this decumulation stage? All right, you can take your geek hat off now because now it's time for this week's Smart Sprint.
On your marks, get set.
Hey, welcome to this week's Smart Sprint, where we are setting a 7-day goal for you to take a little baby step to creating a great retirement. So if you are a normal listener, you're in your 50s and you're either just entering retirement or preparing for retirement. So we've had you look at your asset allocation, and you're probably doing a lot of things. I want you now to start asking yourself, what is my desired outcome for my retirement? Maybe it's to not run out of money as one. Maybe it's to maintain your lifestyle. Maybe it's a lot more than that. What is your desired outcome? And if you've done the previous Smart Sprint, you have an idea of how you're allocated right now. Ask yourself, does it look like it's consistent with what your desired outcomes are? And start to just think about that. But now, let's go get happy. Hey, welcome to the Happy Lab, where we noodle on how to be happy. Hey, I did something that made me very happy last week, and I think you should do this. So my son was in town from college for the weekend, and we were noodling around the mall, or just walking around the mall, and we walked by this very plain storefront, and it said breakout. And I'm like, what is that? And it was one of these breakout rooms. So it's a room, they put you into it for an hour. They had a couple different rooms, and my son and I, just on a whim, saying, hey, let's do this. So he and I did it together. And so they put us into this room. It was like a casino room. And the lady comes in and she gives us a little bit of setup. She leaves the room and we watch this little video that says, okay, you are James Bond and you have 1 hour to retrieve the map and get out. So the room is theoretically locked. It's not actually locked. And then there's like a slot machine. There's a roulette table. There are these mirrors. There's a blackjack table and then some like little gun safes all over the place. And they give you the setup, and then you and your partner or whoever's with you, in this case it was my son, our job for the hour was to figure out clues and to unlock different things that would give us additional clues to figure out the entire puzzle so we can enter a code and exit before the bad guys showed up or something. So it was active problem solving, but this was a blast. What I liked about it was, in this case, my son and I were in a room and we're working together, interacting, trying to think creatively about solving the problems and finding the clues. And there's that manufactured tension to it. We were focused on each other and working together. That's much different than going to a movie or just going out to eat and just sort of talking. This would be a great date night with your wife. It'd be a great double date where the four of you did it together. So you want to have some fun? Go find yourself a breakout room. Well, I hope you enjoyed the show today. Now, one thing I've found is that most people that I talk with don't really have an idea of what's possible in retirement, and that can feel uneasy. So that's why I developed the Agile Retirement Management process, because it helps provide structure and clarity. And one thing that I found that clients that have gone through the process or that I work with on an ongoing basis, they feel more in control and more optimistic about their retirement. So if you are looking to work with an advisor on an ongoing basis or to build a roadmap, go to rogerwhitney.com and book a call with me, and we can discuss how it might fit you. Thank you so much for listening. Until next week, this is Roger Whitney, the Retirement Answer Man.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.